In this video, guys, we're going to look at 7 steps to picking the best dividend stocks. Stay tuned for this one. Hey traders and investors, warm welcome to you. Okay, so one strategy is to pick stocks obviously that have growth or for trading purposes are going to lift up, increase in value or decrease in value if we're going short. Another thing we can do is look to buy stocks that have a good dividend yield. So we stick our money somewhere where we're assuming the capital is going to be relatively the same or some nice growth on it as well, some slight growth on the capital. We're never going to get absolutely crazy capital growth, but some slow capital growth. But the main reason, the main focus, the main thesis of the investment is to look for income from dividends. So that's a different strategy. Let's have a look today at 7 ways or 7 tips, 7 steps we can look at to picking the best dividend stocks. All right, the first one, look for mid to large cap stocks. You want a company that has already grown as much as it can do. In other words, they're not feeding money back into the business to fuel growth in different sectors. They're a big company, large company, or mid to large cap, depending on how we're kind of looking at it. They're reasonable size already, they've got a good market share, and they're not reinvesting money, which means the money they make, the profits they make can be redistributed as dividends. All right, number 2. The dividend payout ratio is 50% or more. So with this profit they have, they should be distributing the profit as much more than 50% of their profit, if not higher, really, that number might be a little bit low, to shareholders. So the money they make goes out to shareholders. Any surplus, yes, they might have some other bits and pieces they're doing for it, but you've got to ask the question, if they're hoarding all the cash, why are they hoarding all the cash? If they're already a mature company, they've grown to a decent size, don't have any significant plans to expand, and they're not going to put massive amounts of capital into some new venture or something, you've got to ask, why are you hoarding the cash? You want a nice, steady, stable company that is paying out most of the cash flow they have as dividends and not holding it for some future venture. All right, number 3. You've got a track record of paying consistent dividends. There's no point in buying a stock for a decent dividend. It looks great on paper. You've done a filtering process. You see a dividend. It's a good yield, all that kind of other stuff. If they've got inconsistent track record of paying dividends, because you need to know that that is solid and it's going to, okay, might tweak up or down, of course, over the cycle of the economy. There's always going to be adjustments and stuff, but you want to see that that is their ethos. That is the way they are doing business. They're generating money. They're paying out X in dividends. They've been doing it for multiple years. You don't want to see times or periods where they haven't, or when they suddenly have big dividends and this and that and the other. You know, it just shows inconsistency. And the whole point of having a dividend stock is for cash flow. So you want that consistency of cash flow, of income. You don't want to be thinking about, oh, well, you know, maybe they're going to start changing it, or is it going to up or down? You need that consistency of paying dividends. So the last thing you want to do is buy a kind of portfolio of stocks, all look great on paper, pay good dividends, and all of a sudden they say, no, we're not going to pay them this year. We're going to all pull in the cash and do something else with it, because it just defeats the object. So a nice track record of paying those consistent dividends. Okay, number 4, guys, the fundamentals must be sustainable. Pretty self-explanatory, but it can make a mistake. You're looking purely just for a stock that's paying dividends, a company that's paying dividends. However, you need to see some sustainable fundamentals. You don't want to see a business model that's poor. You don't want to see something that's got eroded market share, all that kind of stuff. We're not going to go into the whole depth here in the video about solid fundamentals, but just being aware of the point, hey, it's easy to get caught up in the numbers and saying, oh, that's a good yield, that's the other, but then really take some time to dig into actually what the business is doing, how the business is doing, the fundamentals of the business, and making a thesis based on how much that's going to continue this way it is into the next 5 years, 10 years, however long you plan to hold the stock. Okay, number 5, a company has a low CAPEX. You don't want a company that has a lot of capital expenditure, like an airline. You know, an airline's got to pay an awful lot of money out to maintain the fleet, fuel, all the kind of stuff. You want a company that doesn't have that can operate on quite a lean basis, meaning that if times are tough and things start to get stretched a little bit, they're okay. They don't have to be putting capital back in, because the first thing that will go is the dividends to keep the business running. If you've got a nice low CAPEX, it means that they haven't got to keep spending out a lot of capital expenditure. It means that they should be able to keep paying dividends longer when you get the natural expansion and contraction of the economy, of the sector, of the company's growth, or of the company's profitability, should I say. Really, we're not looking for huge growth in this, we're looking for just steady profitability. All right, number 6, the company has a stable free cash flow. Pretty similar to the other things we talked about. You just want them, again, to have a stability. You don't want to see massive spikes and massive troughs. A nice, steady, stable cash flow, so they can plan and they feel comfortable giving dividends. Because a company's got to feel comfortable that, hey, the cash is coming in, we know this is coming, we're expecting this, maybe we're expecting a small growth, as we said, but we know we can rely on there's a decent free cash flow that we can distribute out to shareholders. If the company feels comfortable with that, you can feel comfortable they're probably going to pay that dividend for you for the indeterminate future. All right, number 7, yield has got to be greater than, I'd say equal to, but no, it's pretty greater than the risk-free rate. There's no point in buying a dividend stock. I think it's self-explanatory, guys, but there's no point in buying a dividend stock and taking the risk on the capital and all the other stuff that goes with it if you're getting less than the risk-free rate, whether you're tying your money up in a longer-term bond with the government or whatever it may be. That's the risk-free rate, generally speaking. But I would probably add this as well, that you need to compare this yield and the risk of the dividend and the risk of the stock compared to other assets other investments you can make. The obvious one is just comparing it to the risk-free rate of the bonds, but maybe compare it to some other things as well that are slightly less risky and just see, hey, I'm getting the same as something that's less risk, doesn't make any more sense, or I'm getting a decent, what you want is a decent yield. You're taking a little bit more risk, obviously, when you're buying a stock for a dividend than you are something else, but it's just comparing the two and saying, hey, you know what, it's a decent yield, it's a decent company, it ticks all the boxes, and it ticks the boxes in terms of what my investment and what my portfolio plan is, what my portfolio goal is, what my investment goals are. All right, guys, those 7 tips for you. If you've got any more, add them in the comment section below. See you next one. Take care. Thumbs up. Thank you. Bye-bye.